What's up, guys? Ladies and gentlemen, good morning. I am Jordan Dove. Today is Wednesday, November 10th, 2021. Hope you guys are all well. Hope everyone's great and healthy and you are doing something productive. Okay, I got a challenge for everyone today. I want everyone to express gratitude to at least one person that they know or a stranger. Thank them, compliment them, do something today. That would be great. That would make the world a better place. Also want to say happy birthday to the Marines, United States Marine Corps, Semper Fi. Thank you so much for your service. I have many friends who have served in the Corps and other branches of the government and the military. I wanted to say thank you so much. I hope you guys are having a great day. Okay, tomorrow is Veterans Day, so in honor of Veterans Day, we are going to discuss the VA home loan. It's a great program. We're going to talk all about it, the costs, what goes into it, and everything you need to know about the VA loan in honor of our veterans and service members. Okay, I also have a public service announcement to make. It came to my attention last night when I was at dinner with some friends and family that somebody created a Google or YouTube account, used my mug here, my profile picture, and they were commenting a phone number with circles around it and telling you to message them. Guys, ladies, gentlemen, that's not me. That's somebody else trying to come off as me. All my contact information is on my websites. I have a 702 phone number. You guys have my direct phone number if you have any questions. I will not solicit you to message me directly unless it's via email. I will not tell you to send me a text or a WhatsApp. Send me an email. My email is jordan@doveandassociates.com. That's how you can reach me. Or you can go to my websites, fill out the form. I responded to everybody yesterday. Okay? So be aware that's not me. I've banned the person. I've muted the person. Don't know what else to do. I tried to delete all of the messages, comments that they responded to you guys, so terribly sorry about that. I also reported them to YouTube, so hopefully that will get taken care of, but again, it's not me. Okay, let's go to the 10-year treasury yield. As I predicted last week, 2 decades inclining, increasing interest rates. It's up today. 10-year treasury yield 1.514% currently, and the 30-year fix is up to 3.08%, which is still historically cheap money. Okay, today I'm going to talk about housing and housing affordability, and I'm going to make my second prediction. Okay, my second prediction I'm going to make on this channel. We're going on the 8th episode today. My prediction is that we are going to see federally backed 40-year mortgage programs that are backed by the federal government, Fannie and Freddie Mae. They are out there, but it's usually private. They're not serviced. They're not currently bought by Fannie or Freddie, but I think in the next 5 years, we will start to see 40-year mortgage notes, which will allow you to reduce your payment, but you will pay more interest over that 40-year term. However, historically, people have stayed in their home for 5 years before it gets sold. Now, after COVID, they revised that number. We have more generational living, families staying with each other longer, people staying in homes longer. That has now moved up, and that number has been revised to 10 years. 10 years people are staying on average in a home that they own, which is still well under the 30-year mark or the 40-year mark if we see what I predict is introducing these 40-year mortgage programs. So I want to talk about housing affordability and what that means with the 40-year program. So what the average person can afford in the United States for a mortgage, the average, there's people who can qualify for more, there's people who can qualify for less, but the average is $2,000 per month, all costs included, PITI, which we discussed previously, which is your principal balance, interest, taxes, and insurance. And if you have less than 20% down or you don't have 20% equity in the home and refinance, you have what's called MIP, or mortgage insurance premium. And this is something they did after '08 because what the mortgage company said was, in case something like this ever happens, we need to build up reserves. So there is a tax essentially that they charge you if you put down less than 20% or do not have 20% equity in your home. So if you're paying mortgage insurance premiums and you think you have 20% equity in your home, you might want to talk to a lender and consider refinancing so you don't have to pay that anymore. Okay? So 40-year mortgage, what would that look like? What do you think that would look like? Let's run some examples here. Here are the numbers on a 40-year with 10% down at a 3.5% interest rate with 0.5% PMI, because we're putting down less than 20%, because most people don't put down 20%. The average is actually 6%. We'll talk about that in a minute. But for these examples, we're going to do 10% down. We're going to use the median price in my market. The median price of a home means half the homes sell for more, half the homes sell for less. The median price is $406,500 as the end of last month. That's the median price in my market. So on a 40-year note with 10% down at 3.5%, that payment is under the affordability range of $2,000 at $1,861.58. Now, if you compare that today to a 30-year mortgage with the rate of 3.15% and 10% down, that payment is north of our affordability marker of $2,000, which puts the payment at $2,118. So with that 40-year note, you'd actually have a savings per month estimated of $257 a month, which equates to $3,084 a year. Okay, but the interest paid over that additional 10 years for the 40-year total, that's $314,482 interest that you would pay in addition to the amount you borrowed of $365,900. And of course, that's over 40 years. If paid in full, making monthly payments, the minimum payment every year, that's not making additional principal payments. That's a total of $680,382 over those 40 years, but the affordability rate is below the $2,000 threshold. Okay? For the 30-year note, if you're borrowing the same amount of money of $365,900, you'll have a total interest expense of $200,166.61, totaling $566,066.61. So for taking that savings of $257 a month with a 10-year longer term, you're actually pay $114,000 and some change more in interest over the term of the loan. You could always refinance out of it, but the monthly payment does make it more affordable. So that would be something you'd have to see if that works best for you. And as I just spoke about, people are staying in their homes on average 10 years. So the likelihood of you seeing that loan out for its entirety, for the life of the loan, 30 or 40 years, very uncommon, doesn't happen very much. If you want to rent it out, pay it off that way, I think that's awesome, that's great, but I just want you guys to look at these different situations. But what concerns me, guys, what concerns me is housing affordability. It's expensive to live. Rents have skyrocketed. Mortgage interest rates have stayed down, which has allowed people to purchase more home as the prices increase. But as I predict, those interest rates are going to rise, so housing is going to become more unaffordable, in my opinion. So if interest rates go to a more normalized rate of, say, 4.5%, knowing that the average person can afford $2,000 a month for their mortgage for pity, that same median home price of $406,500 means a monthly payment of $2,404. So now we're getting way over that affordability index of $2,000 a month. So housing would have to be at a median price of $337,000 at a 4.5% interest rate to have an estimated payment of $1,993, which is right at that benchmark of affordability for most Americans. Okay, so let's keep that in mind. This is also factoring in a 10% down payment. And as I said earlier, the average down payment of borrowers in the United States is 6%. And many first-time home buyers who are just getting started in the market use the FHA program, which is a 3.5% down payment. Okay, it's a great program. You get pretty decent rates. You don't need as great of a credit score as conventional to get a better rate. But at today's rates and the median price of a home of $406,500 with 3.5% down, well, guess what? FHA loans in my market, cannot cover that loan amount because it has a maximum loan amount of $356,362, and that's in the state of Nevada. Now, this varies state by state, but if FHA with 3.5% down doesn't cover the median or average price of the home, what are the entry-level buyers to do? They've saved up their down payment, sometimes tens of thousands of dollars. They have their closing costs. They worked on their credit. Their credit's good, and they still can't find anything because they're being priced out of the market. Okay, so let's go back. So at max FHA, with today's rates, the monthly payment with PITI and mortgage insurance premium is $2,100, which is still above the affordability marker. Now, that's max FHA with 3.5% down. But if the rates go to 4.5%, which was really pretty common prior to the COVID pandemic, the monthly payment goes up to $2,379. Interesting. People can't afford that at this time. So to keep the payment at $2,000, that home price would need to be $300,000 with 3.5% down FHA program at a 4.5 rate. Our median homes are over $406,500 and entry-level homes in our market over $350,000. So how does that sustain if prospective new homeowners cannot afford to keep being priced out? So it's going to be interesting to me and to everybody to see what happens. But if wages do not rise and keep up with inflation and interest rates rise and housing remains high due to the low inventory we have and high construction costs because everything is costing a ridiculous amount of money right now, something has to give. So I predict that the federal government, if they were smart, they would come in with a 40-year backed mortgage note backed by the federal government and supported by Fannie and Freddie. I think that needs to happen. I think that will happen. It's just a matter of when. If rates go up, this will make it more affordable. If you go back and look at the history of automobiles and vehicles, you used to be able to afford a vehicle, have a very low payment, be able to pay it off on a 2-3 year loan. But vehicles have gone up in price so much because people want to look good and look flashy and purchase things they can't afford. So what they did was they introduced the 5-year, the 6-year, and now even 7 years to afford that $60,000, $70,000, $80,000 vehicle, and it just depreciates. But you can afford that monthly payment and you're stuck in, and that's what happens. So I think we're going to see this in housing. That's my prediction. Let me know your opinions. Please like the video, subscribe, comment. Shout out to Greg Manarino and all the Lions. Tomorrow for Veterans Day, we're going to talk about the VA home loan and the process of purchasing a home, and we'll see what we have in store for Friday. So have a great day, everybody. Take care. If you have any questions, leave them in the comments. I'll get back to them, and I will not send you a WhatsApp message or phone number. Okay? Peace out. Have a great day. Go make a killing. Bye-bye.